Good morning. I'm Raj Datte, and I'd like to talk to you about Fannie and Freddie. Perhaps you've heard of them. They are the largest participants in the largest lending market, in the largest economy in the history of the world. And I have a bit of bad news if you didn't know. They are quite profoundly broken. They're broken in really the only way that kind of matters, which is that in a predictable way, over time, and on average, they will make bad credit decisions that distort the entire economy. I thought maybe I'd subtitle this presentation after Simon, Doom Loop. I'll give you a Doom Loop. The problem with the GSEs is not that they're somehow, evil or corrupt or any other kind of problem that is less fundamental. The real problem is the most fundamental of all. At their structure, they cannot possibly do their core function. They can't possibly do it well. To expect otherwise, frankly, is just a little bit naive. So you would think, given the magnitude of this problem, that there would be a lot of energy in Washington, D.C. to try to figure out a solution. I spend probably more time than I should in D.C. these days with smart people on both sides of the aisle, and I can assure you there is not a lot of energy around finding a long-term solution at all. It's as though policymakers become transformed into child stars on Broadway. Tomorrow, I'll privatize you tomorrow. And here's the problem. Tomorrow is not an answer. As the CBO kind of suggests to us, 10 years of tomorrows between 2009 and 2019 will cost taxpayers an economic loss of $390 billion. $390 billion, that's $1,300 for every man, woman, and child in the country. Or the former investment banker in me likes to think of it this way. If you gave me $390 billion, I could go across town, buy JP Morgan, I could fly down to Charlotte, buy Bank of America, fly back up to New York, and still have enough money left over to buy Goldman Sachs. That's a lot of money. Unfortunately, there's not a lot of kind of momentum behind getting a fix. Part of the problem is, no one wants to disrupt the thing that basically at this point is the only thing going in the mortgage market. And look, I'm not suggesting, I don't think anyone reasonable is suggesting somehow overnight just unplugging the GSEs. What I am suggesting is, as today's agenda makes clear, we need to make a fairly substantial rewiring of how it is the financial system works. And you can't expect to do that well if you haven't figured out how the biggest market in the country is going to work. You certainly can't ask smaller financial institutions to figure out what their transition plan going forward looks like if you haven't figured out your transition plan for the biggest entities in the market. And how in the world are you going to figure out a transition plan of any kind if you don't know where you're going? So we've got to address this issue. And let me tell you one thing that addressing this issue does not necessarily mean. There's an unfortunate conflation of two things. Look, GSE policy is not the same thing as home ownership policy. The United States has a lot of home ownership. Our home ownership rates are rather higher than most other developed countries. It's not by accident. We subsidize home ownership in a lot of important ways, only one of which is the action of the GSEs. If we want to subsidize home ownership, and I'll leave that to people smarter than I am on housing policy, there are other and more transparent ways to do it that are a lot less distorting to the broader financial system than using the GSE mechanism as it exists today. All right, so let me get to the central tragedy of this little drama, which is why is it that they are doomed to fail over time in terms of credit extension? First, a quick recap on what they do. They got two big businesses. They've got a guarantee business and a portfolio business, which basically are what they sound like. The guarantee business guarantees mortgage credit. The portfolio business kind of holds portfolios of mortgages and mortgage-backed securities. But what do? What's the function that they provide? Three of them. They extend credit, they stabilize liquidity, and they absorb and syndicate interest rate risk. Okay, so far so good. So what's the problem? Well, how in the world do they stabilize liquidity? Well, they do it because they have the implicit or explicit backing of the US taxpayer. I mean, just think about it. When the world looked like it was coming to an end, how is it that Fannie and Freddie were able to keep buying mortgages? Well, it's because everybody knew, and they were right, that the US taxpayer would stand behind them. You can't do this without having the implicit or explicit backing of the taxpayer. That in itself may be not such a big problem, except that having the implicit or explicit backing of the US taxpayer is precisely what you cannot do to build a credit engine that works over time. You can't do it. By the way, it has very little to do with, there's kind of a common narrative that is developed about why it is that Fannie and Freddie got into so much trouble that has to do with subprime. They fell in love with the subprime borrower. In some ways, I wish that was true, because you could just stop, doing that. But the facts don't bear that out. Don't get me wrong, the GSEs had a lot of subprime exposure. I mean, if you took Fannie and Freddie subprime portfolios and put them together and made it like a standalone bank, the subprime bank of GSEs, it'd be like the 20th biggest bank in the country. That's a lot of subprime. Remember how huge these businesses are. The subprime exposure of the GSEs is something between 3 and 4% of the overall credit book. So not surprisingly, the major credit problems are not in subprime at all. This data is from Freddie Mac, third quarter 09. I did have a chance to look at both Fannie Mae and the fourth quarter numbers, and they're not too different. Everything kind of looks worse in the fourth quarter than the third quarter. But the point is basically that, over on this side of the chart, you've got 9 plus 55, $64 billion of seriously delinquent mortgage loans at Freddie Mac at the end of the third quarter, only $9 billion of which, 14%, is associated with subprime. So there is no convenient answer for what went wrong. What went wrong is pretty fundamental. What went wrong at Fannie and Freddie is precisely that which happens with a leveraged financial institution over time if you let it. Let's just talk about the pernicious effect of leveraged financial institutions and how they think about credit. So you and I start with a little bit of capital. Now, under the watchful eye of the Fed and the FDIC, if we're a bank, we can borrow some money, depositor money, unsecured money, et cetera, in order to put that to work in the economy. As Simon pointed out, this necessarily means if you're a bank manager, you have an asymmetric risk bias. If things work out well, you just magnified your gains. Things work out poorly, well, most of that money wasn't yours. But this is kind of how financial institutions work. They necessarily have leverage. This is a bank during the bubble. Under the watchful eye of the SEC, this is an investment bank during the bubble. By the way, existing in the same exact businesses in many cases. And then there's the GSEs. Literally 199 to 1 leverage in the core credit guarantee business. Like, these guys are not evil, but they are human beings. What do you think is going to happen if you give somebody that much leverage? Here's the main problem. So you're a bank, you're a manager at a bank or a finance company or investment bank or Fannie and Freddie. You always have a positive risk bias in terms of making credit decisions. The difficulty, of course, is that consumers have the same kind of positive risk bias in a non-recourse world. The equity markets aren't going to help you rein in that risk, obviously. They have the same kinds of risk bias that managers do. So the first and best line of defense to crazy risk-taking in the financial system is active and engaged debt investors. That is to say, the people who are loaning you the $199 to begin with. That's the problem with the GSEs. Their debt investors definitionally don't care. They're not losing sleep at night about the risk that Fannie and Freddie are taking on because they know that the government's going to be there to back them up. By the way, there is one other watchdog, regulators. Rick Carnell's going to talk about this. If I were you, I would not count on regulators during a bubble to stand up and say, oh, wait, stop the presses. You're taking too much risk when the entire world's capital markets are going the other way. It's just an unrealistic expectation. You need active, engaged debt markets, and that's why this doesn't work. So you've got a major problem and a major kind of disconnect between the two pieces of what it is that the GSEs are supposed to be doing. The end game for these firms is they have to be eliminated, and we need to figure out a transition plan right now. Thank you very much.